I'm Desiree Tyree, and today we're talking about why agencies can be profitable and still run out of cash. Thank you for attending. So, one of the great things about having such a small group today is that we can make this much more conversational than a typical webinar. So, feel free to jump in with questions as we go. I do want to mention that this will be conversational and interactive. So, the goal of this workshop isn't to teach you accounting, but it is to introduce you to a simple 4-step routine that can help you understand what's happening in your business and which can make you more confident in making your business financial decisions. All right. Just a little bit about me. Again, my name is Desiree Tyree. I'm a CPA. I'm also a certified management accountant and an enrolled agent. I own account for data. And on Instagram, you may see me as Creative Biz CPA. My focus is on helping creative agencies understand their finances. The reason I wanted to host this workshop was that I see that many owners aren't necessarily struggling because they're bad at business. Most often they're struggling because they haven't been taught how to use their financial information. So that is the goal of this workshop. Just to do a quick poll, who here has ever thought we are busy, we have clients, we had this big project last week, but when I look at my bank balance, it's like, what is going on? I don't know if I'm going to have enough money to pay these contractors that I have to pay next week. Has anyone ever been in that situation? Okay, you're not alone. Many business owners find themselves in that situation. So what we're trying to do here is give you the tools so that you can plan ahead so you're not in this situation. And if you're in this, you can create a plan to get out of it. All right. So if you aren't using your financial statements, let me know how you gauge whether or not your agency is doing well. So, a few places that I know business owners look based off of working with them is they check their bank balance. They may have a platform where they can check their sales. And so this will tell you how much revenue you have earned in a certain month or certain day or whatnot. Maybe they are just gauging it based off of how busy they are. They may be like, we are so busy, we got to be making money. Sometimes it's just that. And sometimes it's just whether or not you can pay your people. Sometimes you're like, okay, I made payroll, I did pay my contractors. That's all I can hope for. Although there's often doesn't include yourself. But as long as you can pay the people who are working for you, I know a lot of times they're just happy with that. So the problem with these is that each of these just tells you a part of the story. So your bank balance is just telling you how much cash you have on that day at that time. Maybe, maybe later on you check your bank balance and you've lost money. If you're looking at this month's sales on your platform, you only see the revenue part of it. You don't know what is going to come out. You're not tracking your expenses there. You only see your sales. So you know your revenue is great. You know maybe that you did better this month than you did last month, but you aren't checking your expenses there. Also, just how busy we are, that won't tell you how much revenue or how much expenses you're making. Sometimes we work so hard and we're not charging as much as we should, or we're forgetting to invoice people sometimes, or we're forgetting to collect from clients that we've done work for in the past. So all of these are ways to gauge how your business is doing, but they don't give a complete picture of how your business is doing. One example of this would be this $20,000 project that we'll look at quick. So let's say, for example, you have a project that you just started and it's $20,000 in revenue. So great. I don't know, maybe this is not a lot of money to some people. Maybe this is like money that many of us would love to get a project for $20,000. So great. I've got this project for $20,000. That's money in the bank. Oh, they want to pay the whole thing up front too. Great. I had $20,000. So you are just it's money in the bank, it's cash. You look at your bank account. Fantastic. The next day, but then you have to remember that you have all of these expenses coming out. Off the top of your head, you may know that, okay, I have this project. I know I need to pay a contractor. Maybe we pay him $700 weekly. And maybe we have to pay for additional software. We have rent expense that we maybe paid late or is coming out tomorrow. Maybe we have some one-off taxes that we have to pay. Maybe there is some additional equipment that you need to purchase just for this project. So in reality, it's $20,000 that you received will have to cover all of these expenses, especially if maybe you have a contractor where you're just paying them weekly. And you have to stretch this $20,000 out because you may pay them weekly, but you have to pay them the week after that, the week after that. So just thinking about what you have to pay them in the next week, is it sufficient? You have to think about how this $20,000 is going to stretch over this whole project and plan for revenue that you may get from other clients or revenue that you may not get from other clients. You may be expecting to get paid and then they pay you late, or you just have to think ahead about how you're going to manage this revenue based off of your expectations for what has happened in the past. So this $20,000 is fantastic. It's money in the bank, but in reality, you don't really have $20,000. And also think about when you do have a $20,000 project and you're taking a deposit, and the whole project will be $20,000, but you've only received a quarter of it, $5,000 today, and you won't receive the rest until the project is complete or maybe in installments. And in the meantime, you still have to pay your contractors in between that time. So maybe your deposit isn't covering the expenses that you need to cover in between here and the next time they pay you. So again, thinking ahead, having this information from these reports that we're going to look at will help you plan ahead and handle those cash flows better. Here's one other example of how your bank balance is not sufficient to gauge how your business is doing. So your bank balance will tell you how much money you have today. It will tell you, do I have the cash in the bank to pay this bill today? Did that deposit hit? Yes. Did payroll clear? Yes. But it won't tell you why you're profitable, but your cash is low. It won't tell you that. It won't tell you what will happen next month. It won't tell you what extensions you have coming out. Your financial reports will tell you this, will tell you that your projects are profitable. They can tell you what expenses are increasing or decreasing. It can tell you, do you have the money to hire next month? And if you do hire, how is that going to affect your bottom line? It tells you why and it helps you plan ahead. So the 4 steps in the financial routine are categorize, reconcile, review, and plan ahead. So categorize and reconcile are the 2 basic steps that will help you review and plan ahead. So we have to get these 2 basic categorize and reconcile processes in place. We have to do really good at this. And then once we have that information in place, then this review process works much better. So we'll go through each of these 4 steps at a high level. All right, so the first step is categorize. So if you are using bookkeeping software or if you're not, the whole purpose of the categorize step is to put your transactions, your business transactions into the correct category or AKA account, AKA bucket. So here we want to say, okay, I just made this purchase the other day. Was it for office supplies? Was it for a membership? Was it for an event? Was it for equipment? Anything. We just want to put it in a bucket so that later on when we're looking at our financials, we can say, okay, I spent all of this money on office supplies. Whoa, that was a lot of money. Or it looks like, or on your financial reports may look like too much. It's just a way to track how you're spending your money. So this is the first step. The important part about this is that this forms the building blocks for your financial reports. So you want to make sure that you are putting them in the correct buckets, categorizing as accurately as possible. A few things to keep in mind are that if you are using accounting software, their suggestions are not always correct. They will use artificial intelligence to suggest a category or an account. It's not always correct. If it's not right, you can always edit it. Even if you do initially accept what it has suggested, you can always go back and change it. So just keep that in mind when you do see those suggestions, when it has automatically suggested a categorization that you can change it. You need to look at it to make sure it's going to the right bucket. And you also want to be consistent. So if one time you have a Canva subscription, one month you have it going to software and the next month you are putting it to subscriptions, that can really confuse your financial reports when you're later looking at them to see how much you're spending on subscriptions versus software. So you really want to be consistent as well. So those are just a few pointers. Another thing you want to make sure you're doing is making sure that any of your personal expenses, any withdrawals that you make from the business, anything that's not business related is not categorized as a business expense. You won't be able to properly analyze your business if you are including these personal expenses into your business because it will overstate your expenses and it will make your profit lower than what it is. And just to make those better business decisions, you want to make sure that your financial records are as accurate as possible. So just to jump ahead and show you what these buckets can be, I do have a very simple profit and loss that we can look at. It is right here. So here is a very simple profit and loss. We have revenue and we have these expenses here. So these are some types of categories slash accounts slash buckets that you could use for your transactions. And this will be dependent on your business. These can be very subjective. Some are very basic. Like most people will have the same types of expenses. Most people will have marketing and advertising. Most people will have something called insurance or office supplies. But sometimes it's broken down a little differently. Sometimes you won't have your rent and utilities together. Sometimes you'll just have rent. And then you want to have your utilities broken down by electric, water, sewer, and things like that. So the level of detail and the names of the accounts are very subjective. Usually it's plain to see what it's for, but we don't want to be too generic in these categories. We don't want to put general business or just business expense. We want to be as specific as possible so that it lends itself to us making better business decisions based on how those are categorized. So we will go back. We've covered categorize. Like I said, this is the basic building blocks of your financial statements. It's important that we are labeling every transaction so that the numbers have meaning and that we can use these later when we are making our decisions. The next step would be reconcile. Making your books to your bank. So you have your books, which is your accounting books, which is just like QuickBooks if you're using it. But what we are doing is we're making sure that what we have in our books matches the source document. So we want to make sure that we have in our books as far as how much cash our books are saying we have matches what's on the bank statement. So again, we'll go to the financial statements and you can see as I go back and forth to these financial statements, you can see how these impact each other. So we saw how in step one, we looked at as a first step of the process. We saw how that impacts our financial statements and the profit and loss, right? It also affects the balance sheet. We'll look at that as well. But we see how when we are categorizing, if we categorize it correctly, then these amounts should make sense. But if we categorize them incorrectly, then we'll look at our financial statements and we'll be like, marketing and advertising is higher than it should be, or we did not pay that much in insurance. So that will tell you that something was categorized incorrectly. Or maybe it's just something that looks a little weird and you just have to dig into it to see what was going on. But to fall back on the reconciliation part of it, this mostly affects the balance sheet. So this is where I'll say, okay, the balance sheet shows how much we have in cash. It shows how much we have in accounts receivable. What we're doing when we reconcile is we're saying, okay, this is our books. This is our balance sheet. It's saying that we have $42,500 in cash and checking. Is that what our bank is saying? If our bank is saying that we only have $12,500, there's a big difference that we need to account for. So when we're reconciling, we're going to say, okay, what is that difference? What's causing it? Is there some expenses that are missing? Is there some revenue that's missing? We don't really know. So we have to reconcile it. And that usually entails going through the transactions on the bank statement to see what is different between the bank statement and what's different between the transactions that are going into your books. Other accounts that we reconcile are accounts receivable. You want to make sure that this number is correct. This is money that is owed to you from your clients. So if this looks high, if you think that I know we don't have that many clients that owe us money, I know it can't be that, then this is a number you're going to want to dig into and correct, because if it's too high, it means that this money is floating somewhere else and it may be making your revenue too high. So that's another reason you want to make sure that you are reconciling these accounts. If your cash and checking is off, if your accounts receivable is off, all of these are affecting the number somewhere else. Often it is your profit or loss, which means that your revenue could be overstated or understated, or your expenses could be understated or overstated. Basically, it makes your financial statements almost worthless because you can't depend on those numbers to make your decisions. So that's the reconcile part, is making sure that these numbers on your balance sheet in particular match the source document, that they make sense. All right, going back through that's the next step of the process. And what we've been doing a little bit of already is review. So here we want to review your financial reports. So the three main financial reports we are looking at are the P&L, or profit and loss, then the next one would be the balance sheet all the way here at the end. And then the next one would be your cash flow statement. These are the three main financial statements that we look at. A few additional reports that are helpful, and you can pull many reports customized to your business that will help you make your decisions. But a couple of other reports that may be helpful to agency owners in particular are accounts receivable, aging, and project profitability. So we'll go through these reports so you can know what they mean, what to look out for, and how you can use them. All right, so your profit and loss statement, as you can see, we looked at this quickly earlier. It shows the revenue, it shows the expense categories that you've used and how much you spent in those expense categories, and it shows your profit or net income. So at a basic level, you can see that the month of June, Bright Ideas Creative made $66,700 in revenue, and they had total operating expenses of $34,470. So their income or profit was $16,130. So after they paid all of their expenses, they had $16,130 in profit for the month. What this also means is that their net margin was 24.21%, and their gross margin is 75.9%. So gross margin is the percentage of revenue they've earned after they pay all of their expenses, and their net margin is their percentage of revenue they've earned after they've paid all of the expenses. So you can think of gross margin as after we paid all of our direct costs, how much do we have to pay our administrative costs? So we have 75% of our revenue is left over to pay our administrative costs. Another way to think of net margin is to say our net margin is 24.2%. Another way to think of that is to say that for every dollar you've earned, or you've earned 24 cents for every dollar you've earned. It also means that 20K that we were looking at earlier, when we were talking about this 20K, and we also went through the process of how this money doesn't necessarily mean that we have $20,000 to work with. It also means that for a month, that this $20,000 actually will turn into $4,840 after we paid all of our expenses. And this is just, based off of this net margin for the month. Now, we are using the net margin for 1 month, but it's more helpful to sort of get an average over a period of time, maybe 6 months to a year, because, we always have those expenses that hit not in the correct month, or we may have one-off expenses. So it's better to use a margin, an average for this amount. But it does give you an indicator of how much you'll have left from any job you do. So just this number alone, once you have your financial reports, just having this number, you can apply it to any money that you earn to know what you'll have after you pay your expenses. The other percentage down here is overhead, which is 52% of revenue. Overhead is your operating expenses. So here we have rent, utilities, marketing, advertising, professional fees. These are expenses that don't necessarily tie directly to a particular job, but they are expenses of running your business. And a lot of them are expenses that you have to pay no matter what. So you want to make sure that your revenue covers your not only your direct costs, not only your contractors and things that are directly tied to creating that revenue, you want to also make sure that they're covering these administrative costs, especially when you are. So think about that when you are bidding for jobs or quoting how much the job will be. The next report we have is a balance sheet. And this is another report we looked at briefly. So this shows you your assets, your liabilities, and your owner's equity. So our assets we have listed here include cash. Of course, that's an asset. It's money that we have in the bank. Accounts receivable. This is money that's owed to you. Prepaid expenses. Those are those expenses that you pay in advance, meaning that maybe you have a subscription that lasts for a whole year, but you haven't necessarily incurred the expense for next month because the month hasn't arrived here yet. So we would stick that amount in prepaid until the month comes. Usually this is for larger expenses that you pay in advance, or maybe you've paid for an event that's months from now, and you may even be able to get some of this cash back. So it's just not necessarily an expense as of the date of this report. Then we have our fixed assets. Here we have equipment and computers. This will again depend on your business. You may have buildings, you may have vehicles, but these are assets that the business owns. So all of your assets, which is usually cash, accounts receivable, and your fixed assets, they will be in the asset section. We also have our liabilities, which is money that you owe. So accounts payable are bills that you owe you haven't paid yet. You have your credit card balance. Deferred revenue is money that you have received, but it's for work that you haven't necessarily performed yet. So it may be a deposit that you took that you haven't for a job you haven't started on yet. We have payroll liabilities. Usually this is payroll taxes that you will pay later. And then we have our business line of credit. You may have a loan or something like that. So our liabilities are $39,700. And then we have owner's equity. Owner's capital is usually money you've invested in your business. This can often be called owner's investment. It goes by different names, but owner's equity really works the same. They just have different names for it, depending on what type of entity you are, whether you are a sole proprietor, partner, whether you're in a corporation or something like that. Retained earnings generally means all the profit or loss the business has earned throughout its lifetime. It's also a sort of bucket for any discrepancies in accounting, but try not to, we try to keep it clean. Generally, it is all the money the business has earned throughout the year, adjusted by some other things that we won't go into at this time. Net income, of course, is a profit. This will tie to your profit or loss. So we have a net income for the current month of $16,130. That will match the net income on your profit and loss here. And this is just for the month of June. And then we have owner's draw. And this is just any money that you've taken out or personal expenses that you have paid via the business. Important thing to know is that total assets will equal liabilities and owner's equity. So assets is $91,300. And then liabilities plus owner's equity will equal $91,300. Another way to look at this is that these are your assets. And if you sold the business today, you would have $39,700 that you would have to pay to your creditors. And whatever's left is what you have for yourself at that book level anyway. So that is your balance sheet. The next report we will look at is your statement of cash flows. This report is very useful and often not understood, but it is very useful for understanding what has actually happened to your cash. So here we start at the net income of $16,130. As I might have mentioned, profit on your P&L does not necessarily mean cash in the bank, just because there are a lot of things that go to different reports. So this report makes up for the differences between the profit and loss and the balance sheet. Just as one example, we looked at that owner's draw of $6,000. That $6,000 is not a business expense, so it's not going to show up on your profit and loss as a decrease to profit. But it will show up here as a decrease because it's reconciled, showing you how much will happen to your cash. So we start with this first line of $16,130 in net income. Another expense, and then it makes adjustments to account for cash either not going out or going out. So one expense that was on our profit and loss was depreciation. Depreciation is not a cash expense. It is a way to record an expense for an asset over time instead of recording that expense all at once. So our fixed assets are those assets that we expect to use for longer than a year that are a considerable amount of money. And instead of directly expensing them all at one time on your profit or loss, we spread that expense out through depreciation. However, that cash has already been spent. So even though we're just recording the expense on a monthly basis, we've already spent this cash. So we are going to add this cash. We're going to add this amount back because this cash didn't really go out. So to our net income, we're going to add this $316 in cash. Now we're going to decrease our cash by $5,200 for accounts receivable. Accounts receivable is that cash that we've earned from our clients, but we haven't received. So we've recorded this revenue. We've recorded it in this net income. It's reflected here, but we didn't actually receive the cash. So we're going to back that out. We also have a decrease in accounts payable. Accounts payable are those bills that you are recording as expenses and that you may or may not have paid. In this situation, since our cash is decreasing, it's showing that we paid down our bills by this $1,800. So we're decreasing our cash for that amount. And then we have an increase of $3,000 for deferred revenue. And this is that money that will not be reflected in revenue because we haven't necessarily earned it yet, but we do have it. So we're going to add that $3,000 because we do have that cash. So after making all those adjustments, we have $12,446 in cash that we actually received in the month of June. Now, we have investing activities, which is different types of transactions. As an example, we have a purchase of equipment. So just as we were talking about accumulated depreciation or a depreciation expense, if we have purchased some equipment, it won't necessarily, and it's over a certain amount and it's for something that will last a long period of time, then we would enter it here. So if you purchased a vehicle for like $25,000, it wouldn't be reflected in your net income because we're going to record it as a fixed asset, but the cash did go out. So for example, we did spend $25,000 here, and this would be a negative number that we would be deducting from our cash. And then we have owner's draw. So we had $12,446 in cash that we collected in June. And then the owner took out $6,000. So that has decreased their cash to $6,446 for the month of June. So this is how you could read this statement of cash flows. It tells you exactly what happened to your cash. It's a very useful report. Now we have accounts receivable. So if you are invoicing clients, this is another report that you should definitely look at. So we have, reading this report, we have Bloom and Co., who owe us $8,500, but it's current, so we're good with that. But we also have this Olive and Oak Company invoice that is greater than 90 days old. So the question here is this correct? Have we received this money? If we have received it, then why is this still out here? Oftentimes, when it's still on this accounts receivable report, that means your revenue is overstated. Sometimes they just paid a different way and maybe it went to the wrong account. But either way, we have to figure out what happened to this cash and why it wasn't applied to this invoice to make that correction. Or maybe they didn't pay and we just need to follow up with them and see if we can collect that money. But this is cash that hasn't been received. Depending on your policy, these are just definitely invoices that you want to follow up on if the money hasn't been received. And if it has been received, you're going to want to clean this up to make sure your books are correct. The next report here is the project profitability. This is showing your projects. This is a useful way to look at your projects, see if you are charging enough. So here we have the bill of revenue, and then we have direct costs. Like I said, direct costs are those expenses that are directly tied to that project. So if you have definitely hired a contract just for this project, you are going to want to add that as a direct cost. Any equipment that is just for this project, you're going to want to add it to this direct cost. Any special advertising for this project, you're going to want to add it to that direct cost. Once you have all of that recorded, then you can see your gross profit and then you can see your margin. So we're saying that 79.3% of the revenue earned from this project is money that we can use really to pay for admin costs. And then after your admin costs, you can sort of see what you have left over. So I just want to have a note down here that says that gross margin covers direct costs, but projects must also absorb overhead, which is the rent, staff subscription, those admin costs that we talked about earlier. So at current overhead levels of 52% of revenue, and we'll go back to the P&L to look at where that number came from, just right here. These expenses, the 34,470, these are your overhead expenses. Operating, admin, this is all other words for overhead. This is 52% of revenue. So if we go back to the project report, at current overhead levels of 52% of revenue, the project below 60% gross margin may not cover its full share of those admin costs. So it's important to not only track those direct costs, but you also want to make sure that a percentage of that project is able to cover your administrative costs as well. All right, so we went through those four reports. The next step is to plan ahead. Now that you know your numbers, now you can say, okay, can I afford to hire somebody else based off of my expenses for June? And we don't want to just look at 1 month. We want to look at a history. Right now, we just looked at the month of June, but we want to go back and sort of see trends and see, okay, we know we expect advertising to be $1,500 every month. So based off of that, we know that advertising is likely going to be $1,500 for the next few months. We know that our software is usually around $1,200 each month. We know that our rent is $3,500 each month. We know that we have to purchase some insurance, or there may be some one-off expenses that are coming up. Maybe you have a membership that you have to pay for annually. So once you have these, and what your expenses are, then you can plan ahead and you can say, okay, do I have the money to to do this? And you can plot it. You can say, okay, let's pretend like I hire an additional person and it's going to cost me $2,500 a month. How is that going to affect my bottom line? You can plug in your revenue. You can say, okay, on average, we have these reoccurring clients that make us this much money a month. We are expecting a new client year, or we expect this client to fall off. How you can see how that decrease in revenue is going to affect your bottom line and plan ahead for it. So planning ahead means using those numbers to determine whether or not you can hire additional help, whether or not you have the funds to buy equipment, how losing a client is going to affect your bottom line. And it also tells you how much you set aside for taxes. So your taxes, for the most part, are based off of your net income. So if your net income is saying that you have earned a certain amount, then you want to put a percentage of that aside, set aside a percentage of that for taxes. If you are, for example, we'll go back to this profit or loss that shows us that we made $16,130 in June. So if this was all the money we made for 1 year, then we want to set aside 30% of that for taxes. And that's just a general rule of thumb. Now, based on your situation, you may have other things going on and your effective tax rate may be lower. So 30% is just a general rule of thumb, but working with your taxpayer, your tax planner, they would want this information to help determine a good amount to set aside on taxes because you made a profit. So you're definitely going to owe this money, even though, we look at our cash earlier and we see that our cash was actually $6,446. And that's where it gets really confusing for a lot of business owners. They're like, my P&L is saying that I made $16,130, but I only have $12,446 in the bank, or an increase of $12,446 minus the $6,000 that you took out for yourself. So that's where it gets a little confusing because you're gonna get taxed off of that net income, really depending on some other factors too. But it's just something to keep in mind. So that was the last step. Now, so the real goal, I know we looked at a lot of reports, but the real goal is not to create a ton of reports or spreadsheets that you have to look at, although that is what we are producing in most of the time. But what this is really doing is it's giving you the confidence to make better business decisions and to plan ahead so that you are not scared about what's going to be happening in the future. If you know that you have these expenses coming out, if you know that you're going to lose a client and you know how this can potentially affect your bottom line, and you can plan ahead. You can say, okay, I need to cut back on my expenses. I need to let this contractor go. I need to decrease my payroll costs. I need to maybe look into bringing somewhere else. It lets you it makes you it gives you the information you need to plan ahead so that you're not in a position where you are scared to look at your bank account. So just to give you a little homework, just to give you some homework, based off of this workshop, these are some things that you can do to see where you're at and to see if you were in a position to use your books for this process. So first, I want you to review your reports if you have reports. If you don't, then I hope this workshop express the importance of having reports for that purpose. But the first thing I want you to do is review your reports and see if they make sense. Look at your profit and loss and see if it is reflecting the revenue you believe you've earned, if it's too high, too low. Look at your expenses and see if those make sense. Look at your bottom line and see if that margin is where you want to be. Then I want you to compare your cash versus your profit. Look at the money you have in the bank and then look at what your profit was for the year, for the month. Maybe see if the increase or decrease in cash that you made for the month matches the statement of cash flows, and it should, but it may not match your profit. And then follow the 4-step routine. Categorize your transactions, reconcile, review your financial reports again, and plan ahead. So I hope this was very helpful. I went through it at a high level and I may have talked too fast, and there is a lot that I left out, but I know at a high level, the 4 steps are categorized, reconcile, review, and plan ahead. So, how I can help is we can have a financial clarity session where I help you get clear on where you stand. And this is just sort of going through this whole process with you to see how to get a more personalized approach and how it can help you. I also offer monthly bookkeeping where I am really doing this for you each month, categorizing, reconciling, and sending you your reports. Planning ahead is more of a fractional CFO type thing. And so if that is something you're interested in, where I'm actually helping you to plan ahead and see into the future using these financial reports, and that's more of a fractional CFO advisory role. Also do meet you where you're at. So if none of these seem to fit you, just let me know. Like for example, I do offer quarterly support for some people where they handle the monthly things, they categorize, and then I just come in every month and just make sure that everything looks right. So if you are interested in any additional help or if you have any questions, feel free to reach out to me. My email is here, dtari@accountfordata.com. I will be around for a few minutes to answer any questions you have. But I mean, if you don't have any, I just want to thank you for joining me today. I hope that this was very helpful and I hope that you are able to implement this 4-step process into your financial routine. Thank you.